We've got one final discussion, and it's one very close to my heart, and it's about economics and the macroeconomy. We've got three great panelists going to join me up on stage, and I would say to our panelists, please, before you join me on stage, if you could grab your little voting device, and also to everyone here in the room, if you could have your voting device ready, because once again, we are going to be asking for your thoughts and your opinions and your contributions in this session. We appreciate it so far. Can you continue that in the next session? Great stuff. Thanks very much indeed. Let me invite our panelists on stage then, if I can. Three eminent commentators. First of all, James McCallum, Timothy Fox, and also Gıyas Gökkent. Gentlemen, if you could join me up on stage. Let me offer brief introductions of our panelists. Gıyas, hello, nice to see you. Tim, hello, you're very welcome. James, how do you do? Take a seat, please.
Thank you.
Have a seat in no particular order. James McCallum, to my far left, is the CEO and chairman of LR Senergy Group, an energy services group, which was acquired by a British organisation late last year. Mr. Tim Fox is head of research and chief economist at Emirates NBD, a bank based here in the United Arab Emirates. And Dr. Gıyas, to my immediate left, Dr. Gıyas Gökkent, is an economist, most recently chief economist with National Bank of Abu Dhabi, has held a number of positions throughout his career as an economist, as an asset manager as well, and also within academia. Gents, let's begin by looking at the bigger picture through to 2020, because it seems like we've had a transformational shift over the past 6 months or so. If we'd been here this time last year, we'd have been talking about emerging markets. We'd have been talking about the BRICS and emerging markets driving energy demand through to 2020, happy days. But that seems to have changed, doesn't it, over the past 6, 12 months or so. The BRICS losing steam, and the comeback kid, if you like, of the global economy is the OECD, the North America, and even Europe, even Greece might grow this year. So Dr. Gıyas, if I can turn to you first of all, is this a medium-term shift through to 2020, the return of OECD and the decline of emerging markets?
Yeah, I don't think so. I mean, I think what you're referring to is a relative slowdown. So whereas perhaps the Chinese economy was growing at 10% per year, they're slowing down to 6-7% per year. I think ultimately, because of convergence, because the emerging markets are still in the catch-up phase, I think you will continue to see more rapid growth in emerging markets. That will simply mean perhaps around 4 or 5% growth rather than the more rapid pace that we saw earlier. But I think, so therefore, in terms of the, where the incremental demand for energy will come, it will continue to be, I think, focused on the emerging markets.
Tim, what's your view at Emirates NBD, this shift towards the OECD as an engine of growth? Is that going to last through 2020?
Well, I think what we're seeing is actually a normalization, going back to a situation where the developed world is starting to get on top of its problems, starting to deal with its problems. So 5 years after the crisis in 2008, 5 or 6 years after that crisis, eventually, finally, we are coming out of it, and the United States inevitably is leading the way. And I think as that happens, it pulls up other parts of the world economy. I agree with Gıyas. I don't think it's mutually exclusive. I think everybody will enjoy the recovery. The emerging world may see slightly softer rates of growth than in the past. The developed world needs to add more growth to what it's been doing in recent years. It needs to start to pick up back to previous potential growth rates. We're still quite a long way away from those. So it is an encouraging time, I think, at the start of 2014, and I would probably see developed world continuing to pick up in the next few years.
I mean, you say it's encouraging. I've had a couple of economics books I've been reading over the holiday period, and they're both pretty depressing, with dismal science being very dismal. One is by Stephen King at HSBC. His book is titled When the Money Runs Out. Draw your own conclusions. The West is bust, basically. And the other one is by Ruchir Sharma at Morgan Stanley, Breakout Nations. And he's saying basically the emerging markets boom is running out of steam. The BRICS are a busted flush. Last decade was an anomaly, and you can't rely on the emerging markets to generate growth in this decade. What do you think to that? You say there's encouraging signs at the start of 2014, so you're more optimistic.
Well, I think I don't think you can, to say that there are encouraging signs doesn't mean that we're absolutely in the clear. and everything is going to be bright and rosy forever onwards. Certainly there are big issues still to be addressed in the developed world. Population changes, demographics are all changing. All these issues have to be accommodated. But at least there has been a policy response to a certain extent, and I think that is producing results, certainly in the United States. It is also producing results, thankfully, in the Eurozone, although it's still very, very early days as far as that's concerned. Obviously, there are big challenges there. Likewise, in Asia, there is an attempt to try to soften growth in China. Let's see if that comes off in a manageable way. Japan is going the other way and trying to promote growth in a very aggressive fashion. How long will that last for? Those are the sort of other big issues. But I don't think it's the case that you can't be encouraged by what's happening just because you also have sort of big question marks about some of the big structural issues that face the world.
If I may just quickly jump in there. I mean, if you look at the share in global economic activity, in the global economic pie, what you've seen since the Second World War, obviously, is this relative erosion in the share of the US, and then later in the erosion of the share of Japan and Europe and so on. And the gainers, obviously, have been emerging markets. But what's interesting, actually, is to what degree that gain is actually concentrated in just a few emerging market economies, in particular China. So you look at the share of the US economy in 1993, about perhaps 27% of the global economic pie. By 2018, projections suggest that that will go down to perhaps 22%. But the main losers, interestingly, are the Japanese economy in relative terms, and also to some degree now, because of the slowdown in Europe, the Europeans. But the primary gainer actually has been the Chinese. So this idea that China has become the workshop of the world and manufacturing activity shifting there. And that's why, of course, almost half of the incremental annual demand for energy was coming from China. So going forward, is that going to change materially? What the projections say for the time being is that that convergence, I think, was very rapid in the past decade. Going forward, it will slow down, but it will continue. So what you'll see is, in terms of the share of the Chinese economy in the global economic pie, they still increase it by around 2 percentage points over 2018, for example. So the trend continues at a slower pace.
James McCallum, if I can bring you in here, you're not a dismal scientist, you're not an economist, you're an engineer by training, you're now a business leader. How do you read these shifts, if indeed they are shifts?
Yeah, I think if you come off the back of the session that we just had, which I thought was a wonderful grounding for this economic discussion and in the conversation we've got here, as an engineer, obviously I take a look at the macro aspects of it. I was trying to think of a strapline from the previous session, and that defined there, and I think it defines now. And the strapline that I thought came through, particularly from Ali's comments, where you play the game, the cards you've been dealt. You play the game you can. And when you take a look at what's happening in the world today, I think one of the things which constantly seems to be missed for me is that one of the biggest economic shifts that have been happening in the course of the last 5 to 6 years, a shift within the Chinese economy away from being an economy built on export to an economy built on internal drive within China. And if that has meant a sort of a subtle shifting between 10% growth and 7% growth as that game's been played out, I don't think that's particularly material. I think what is material is that if you move from an export-based economy to an internally based economy, you inbuild sustainability. And I think for me, looking at that, that's a far more important factor. The United States has got shale gas, which is enabling it to produce lower cost of energy and therefore increase its levels of manufacturing. So we heard about Volkswagen, et cetera, et cetera. I think that's particularly material. I share the Turkish minister's view that I don't think we're going to see wholesale move within the United States towards exporting gas when they can see internal value coming from it. I thought that was a really excellent point that was made there. And I think within the emerging energy markets or the BRIC economies, I think, again, one is going to see the mobility, particularly if you're like Brazil or Angola, where you're producing oil. Oil will go where oil is wanted. It's as simple as that. So from a macro level, I think, United States returning back to a sort of a longer-term view of security built off the maturity of the economists that live there. The same within Europe, and I think the emerging markets beginning to transfer towards internally generated economies. All of that, I think, is a great thing.
Very quickly, in 30 seconds, you sold your organisation a few months ago to a European company. Were they buying into the emerging markets play of Senergy, or were they thinking more about OECD, your presence in Europe, your presence in the United States, when you had those conversations? Just 30 seconds.
30 seconds, they were buying into one of the other words which featured in the last section, diversification. Lloyd's Registered Group has been around for 250 years and is probably one of the biggest names in the marine industry. They look at what's happening in the marine sector, and they decided they wanted to get strongly into the energy sector, and in particular they wanted to get into a company that was in the similar markets to themselves, Asia, Africa, and the energy markets of Europe, and that's why they made that investment decision, and I'm delighted to have them on board.
Let's find out what the audience thinks. If you can grab these little devices, please, and gents on the panel as well, if you would as well, keen to hear your views. Zamir, can we have the first question, please, in this session? Dead simple, will the global economy witness another major shock before 2020? Let's start the countdown now. Yes or no? We'll drill down into what that may or may not look like in a few moments' time, but first of all, let's get the sense of whether we think there's dark clouds on the horizon. Split, 50-50. Just quickly, if I can ask, these are anonymous, but you're on the panel, so you get to divulge how you voted. Gıyas, how did you vote?
I said yes. I'm a traditionalist. I believe that cycles will continue as long as you have people around, psychology is around. So traditionally around every 7 to 10 years we get problems. Now where those problems arrive, they pop up in different places. That's another story.
Tim?
Similar view in the sense that I think about my career goes back quite a long way. So I can remember the 1987 stock market crash, and the next one following that in terms of magnitude was clearly 2008. But in between that 20-year gap, there were quite a lot of other things going on. There were ERM crises, there were crises in Russia, there were crises in the emerging markets in Asia, in Latin America. There was the dot-com bubble and crash, and all of these issues. So every few years you do get a kind of a crisis. I'm not sure we're going to get one on the scale of 2008. I'd be doubtful about that.
James McCallum?
Must be a degree discipline thing. No. So I think for me, subject to reasonable political stability existing across this region, I think no. For the reasons I said earlier on, I think I see fundamentals which just fill me with encouragement.
Now, let's get the next question, which is on a related theme, Zamir. Can we get that one? A little bit more granular now. So which of the following will present the biggest economic challenge through to 2020? And you've got a choice of 5 here, you can see them. A declining US or European middle-class real incomes. Secondly, the explosion of the new Asian middle-class consumption. 3, global sovereign debt levels. 4, the global population growth. Or 5, youth unemployment. I know there are a whole bunch of ones, but we've narrowed it down to these 5. Which one of these, let's start the countdown now, most closely tallies with your view of the biggest economic challenge through to 2020? 3, 2, 1. Here we go. So youth unemployment is clearly an issue. I wonder to what extent that is a factor, gents, of where we are. We know that here in the Arab world, youth unemployment particularly is an issue. Gıyas?
I mean, this depends where you are on the cycle. As you move away from 2008, as you move away from the crisis in the Eurozone and so on, obviously the picture should improve. So I'm not that pessimistic. And if you look at actually the growth in population and so on, it's actually slowing down. So is it going to be, I think unemployment is always going to be a macro issue. Is it going to be a more pressing issue going forward? Well, probably not more pressing than it is currently, frankly.
But it's interesting, isn't it, Tim? If you group together 4 and 5, demographics is clearly the issue that people are looking at most of all, and combined well over 50%. I mean, what's your view with the population growth? Is it more hands to work or more mouths to feed?
No, I think it's for obvious reasons that those are the issues that people are concerned about when you're thinking about your own children and thinking about the outlook for them going forward. I voted youth unemployment as my as a point of interest. You know, I think certainly this region has an issue in relation to employing youth and young people, but also where I come from in Europe, that is also a pressing issue as well. In terms of the other questions, I think declining middle classes incomes in the US and the Eurozone, yeah, that's to some extent interesting and important. I'm not sure how much that's going to happen. Emergence of the new Asian middle class consumption, obviously in some respects quite positive. In others, though, as Asia becomes more middle class, you know, it's open up to a kind of middle income trap and questions there about whether they have the ability to move beyond sort of and keep the energy going that happen when you're trying to grow into the middle income bracket. I think the sovereign debt issues are getting addressed at this stage, so I'm not sure that I'm too concerned there for the time being at least. But I think certainly it's natural for people to be concerned about unemployment and population issues, given that we're all really thinking about our families. By and large.
30 seconds, let me pick up. Not too concerned about sovereign debt
I think
in Europe and the United States?
I think those issues have been partly addressed. They are being addressed if they haven't been at the moment. Europe seems to be on an improving pattern following the measures taken over the last couple of years. Whether that will be succeed is still a moot point. Japan is still the country with the most concerning levels of outstanding debt. I think that remains the sort of concern there. But I think in terms of the United States, clearly also big debt issues, but I think the ability to be able to manage those given its size and its importance.
James, I'll come to you in a second. First of all, though, Gıyas, on this issue of sovereign debt, you're an economist. I voted for 3. I don't quite lie awake at night worrying about sovereign debt in the United States, Europe and Japan. But this is, to me, a big issue. We have just kicked the can down the road and we've sowed the seeds of all kinds of problems going forward. That's my view. That's why I voted for number 3. How about you?
Well, there's a reason why, of course, sovereign debt levels, particularly in the OECD, have gone up. I mean, it is almost a duty of governments to lean against the wind in tough times and to stimulate economic activity. So when the private sector pulls back, as it did after 2008, you know, governments had to step in and they had to engage in you know, budget finance. So anybody with some leaning towards, you know, Keynesian economists, I think, would understand that. So where we've come, actually, you know, you look at the sovereign debt levels in the last 5 years, they've gone up substantially. Now, looking forward, I think, yes, that's why you're seeing, for example, in the US, these big debates regarding which way things will go and so on in fiscal matters. I mean, for the time being, what we're told essentially is that US debt levels will stabilize and then come down slightly. And then if the long-term issues of aging and so on and the associated expenditures, Medicare and so on, are not addressed, then there's a long-term problem. But when you say global, you know, if you look at, for example, this part of the world, well, for the Middle East, at least the oil exporters, we don't have that issue. So that's why when I think about, you know, some of these questions, in my mind, for example, I voted for population growth. Why? Because there's going to be more demand on resources, and ultimately some of these resources are finite resources. I mean, if you look at, for example, the projections for energy prices, there are currently 3 scenarios. And one scenario is the high price scenario where you have oil potentially at maybe over $200 a barrel, you know, in 2020. Another scenario sees it around, that's the reference case, around $140 a barrel. So, you know, this demand on resources as population grows, I think on finite resources is the primary problem in my mind.
James, how did you vote?
Global population growth, same thing again, but I wavered. It would have been number 5 if it wasn't number 4. I think the youth unemployment issue, particularly here in the region, massive, but it's massive elsewhere in Europe and the United States. And I think if you're looking towards sustainability in any agenda, we have to look to the youth. It's always interesting to me that we work in an industry where we don't even properly address the, if you like, the forward path of knowledge requirement and how we engage youth within our industry. And I know that's an agenda for later on this afternoon. So great, I'm looking forward to that discussion. But global population growth, areas like Africa, emerging middle classes, an emerging Chinese population, all of whom want to step up from their push bike to their motorcycle to their Mercedes-Benz car, potentially massive effect on the world on an economic standpoint.
And it's interesting, though, you said global population growth is what you voted for, but you've said to me a number of times at these forums on my radio show that for the energy industry, the problem is a shortage of talent.
Absolutely.
And there seems to be a complete mismatch there. Youth unemployment is a big issue, and yet you as an employer, as an industry, can't get talented staff, which suggests that there's an education problem there.
There is an imbalance that came out from around about the last decade. If you take a look at the United States in and of itself, going down from about 35 universities producing petroleum engineers, at its worst point down to about 6. And that was because young people just did not value a career in the energy industry. You know, anybody who's directly involved in the energy industry in this room, we all share some responsibility for that. You know, I simply always ask the leading executives that I sit alongside, when was the last time you went into a university and talked about your career or your company to students? I ask you today, I don't ask you to answer it, but reflect upon it. Until we're all doing that on a very regular basis and encouraging young people to come into this industry, we will continue to have a problem.
Zamir, can we get the next question, please? A couple more questions before we break for coffee. China question. Very simple. How many of the audience expect to hold China yuan priced assets by 2020? That could be physical assets, it could be yuan currency bank accounts, just like we hold dollar bank accounts today. How many of you expect to be holding yuan priced assets by 2020? Let's start the countdown. It's a simple yes or no answer. I know there are restrictions today on what we can and can't hold. That may change over the next 6 years. We shall see. No. Well, that's interesting. Despite the rise of China, most of us expect that we won't be holding yuan-priced assets by 2020. Let's have the final question, Zamir, on this. And this is about monetary policy, turning off the taps, tapering, call it what you will. After 5 years of loose monetary policy, we do finally appear to be entering a period of tightness. Here's the question. Which of the following outcomes do you most align with? Just 3 options. You can see them written there. The first is that money will get more expensive, curtailing production capacity expansion, and that in turn will squeeze energy prices higher. Okay, higher energy prices. Number 2, getting back to normal trend lines of monetary policy is going to make it easier to predict future supply and demand cycles, increase investment in building energy capacity, so more energy capacity. Number 3, emerging markets will suffer capital flight, a period of economic weakness, lowering demand, and with it, the price of oil. Which of those? Let's put the countdown on now. Broadly speaking, which of those most closely aligns with the way that you feel about the next 6 years or so? Okay, so there's general support for both, but most of you think we're going to be getting back to normal. Tim, this speaks to your idea about a return to normalization.
Well, I think it's healthy that we are moving into that phase. I obviously voted for 2. I think number 1 is probably more for the aficionados here with us today, which I'm not one. But in terms of normal, I think it is important that the world economy and the political system gets back to a kind of normalization in terms of interest rate setting, in terms of the price of capital, and that will, find equilibriums in terms of demand and supply. It will create investment opportunities, it will create the potential for growth. I think it's been unhealthy that we've had extraordinary monetary stimulus for quite so long. I think that has distorted incentives in the United States, it's distorted them globally, distorted markets, and I think it's positive over the long term that we are starting, hopefully, to move away from that. Quantitative easing starts to be unwound. Eventually there will be rises in interest rates. Those, when they happen, will be for the right reasons, I assume, and that will be because of an improvement in the economy, global economy.
James, we're running short of time now. At the end of this session, I'm going to ask each of you gents to give you a kind of 30-second prognosis for the global economy through to 2020. First of all, though, James, the issue of monetary policy, as economists, we obsess over these things, obviously. But as an engineer and business leader, how big an issue is monetary policy for you?
It's simply access to capital is how we look at it from the standpoint of can we gain access to capex for investment in the kind of projects we want to drive forward. We look at it from a project finance standpoint of investment, debt investment vehicles, and ultimately equity investment vehicles, and look at where that money is going to come from. So it's very important. For the record, I voted 2.
Thank you. And Gıyas?
Yeah, I voted for 3. The reason why I voted for 3 is, look, tightening hasn't yet really taken place in the US. We are still in a period of extremely accommodative monetary policy. And if you look at when tightening interest rate normalization is going to occur, it's actually about a year and a half, 2 years. So, I think the fallout from the interest rate normalization hasn't yet fully taken place. I think there's plenty of opportunity and space and time for these things to happen. So generally, when you look at periods of interest rate tightening, that tends to be negative for commodities, and about halfway through also for stock markets. So I think in terms of asset price volatility, I think we're not done by any stretch of the imagination. I think you will see it as interest rate normalization comes to pass. And so I'm looking at some problems for EMs.
The coffee is percolating. It is almost done. Before that, though, your 30-second conclusion, gentlemen, the global economy through to 2020. James McCallum.
I'm going to stick with a follow-on to this point on 2. One of the things that I observe we are seeing increasingly in the energy industry is diversification across lots more new companies coming to the fore, many new independent oil companies, and I'll come back to the words of Ali, a change in the relationship of suppliers getting closer and closer to their customers. Small independents are characterized generally by people who have a real can-do attitude, who may have been in a major, stepped out, want to do something, want to get out there and prove they're can roll the dice one more time and deliver something really, really special. And against the backdrop of that level of innovation and collaboration, I think it's got to be 2.
Thanks very much indeed. Tim Fox, your 30-second prognosis?
For me, certainly I'm optimistic to a certain extent, but really here I'd just like to highlight the sort of issues or the problems that might occur. I think a lot of the problems in the last few years have been pushed under the carpet to some extent, and I think those will come back down the road. I think in particular in relation to regulation and controls and reductions in leverage and the kind of regulatory framework that you're seeing globally. I think those are going to inhibit ultimately growth, so a slow recovery overall, which may create the potential for risks in terms of what we talked about in terms of youth unemployment and social tensions. I guess I'm speaking more as a European in context of that, but those are the sort of concerns that I have, that perhaps the answers to the crisis are perhaps going to create the potential problems for the future in different ways than the crisis that we've just seen.
And finally, Gıyas Gökkent, the next 6 years in 30 seconds. Okay. What's going to happen?
I'll start with commodities, since this is the area of interest, I guess, for this group. Look, I see commodity prices softening, so that's great for economic activity. I think that the policy will normalize, so you will see interest rates go back to 4% instead of 0%, the federal policy rate. In terms of fiscal policy, I think you will also see less budget deficit financing than we've seen, let's say, in the past few years, particularly in the developed economies. But I think you'll continue to see this convergence story, this relative erosion in the influence of the developed economies, and therefore greater say for the EMs, and particularly, as I said, a concentrated number of EMs such as India and China.
Gentlemen, thanks very much indeed. Time for coffee now. Who fancies a cup of tea and a croissant? Yep, sounds like a good idea to me. But listen, there's loads of great stuff coming up later on, so no sneaking out. First of all, if you remember at the beginning I mentioned these little forms on your table. This is to register for the breakout sessions later on this afternoon. You've got the new energy contract models and women in energy. You can register at the registration desk just there. They happen after lunch this afternoon. Before that, we're going to take a half-hour coffee break. When we come back, we've got some independent Arab oil companies and INOCs to emerge as 2020 players. We've got some presentations and a discussion on that. And we're also going to be looking at renewables, but not just renewables, renewables and clean energy. And some interesting thoughts, I know, to come on that. So we look forward to seeing you back here at 11:30. In the meantime, enjoy your coffee break. And if you want to do some active networking, don't forget, on the app, you can register to network and maybe use that as a way of connecting. But for now, to our panelists, thanks very much indeed. To James McCallum, Tim Fox, Gıyas, Gökkent, thank you indeed. And thank you for all of your contributions this morning. We'll see you soon.